For over a century, the flickering light of a single filament represented more than just the end of darkness. It was the birth certificate of the modern world. General Electric was not merely a company, it was a secular religion of progress, founded in 1892 through the fusion of Thomas Edison's brilliance and J.P. Morgan's cold financial steel. To the American family of the mid-20th century, the cursive GE monogram was a seal of ultimate domestic security, appearing on everything from the monitor-top refrigerators in their kitchens to the massive steam turbines that hummed in the heart of their cities. It was an era of industrial absolute, where the company's motto, "We bring good things to life," wasn't just a marketing slogan, it was a social contract. For 3 generations, a job at a GE plant in Schenectady or Erie meant a mortgage paid, a college fund secured, and a golden year's retirement that was as certain as the rising sun. But beneath this veneer of fluorescent-lit stability, the seeds of a radical, cold-blooded transformation were being sown in the mahogany boardrooms of Connecticut, preparing to sacrifice the long-term health of the giant for the short-term dopamine hits of Wall Street's quarterly expectations. The post-war boom turned General Electric into a sprawling, multi-limbed industrial god. It was a conglomerate in the truest sense, a massive organism that mastered the Sloan model of corporate management, where every division, from plastics to medical imaging, was a fortress of engineering excellence. By the 1960s and 70s, GE was the primary architect of the American infrastructure, building the nuclear reactors that promised electricity too cheap to meter, and the J-79 turbojet engines that powered the supersonic dreams of the Cold War. The company culture was one of extreme discipline and technical rigor, a place where GE lifers spent 40 years climbing a ladder of brushed steel and precision-molded polymers. It was a period of high-margin dominance where the company's internal training center at Crotonville became the West Point of corporate America. This was the peak of the industrial cycle, a time when GE's balance sheet was as heavy and immovable as the 200-ton locomotives rolling off its assembly lines. Yet, as the 1980s dawned, a new and more aggressive philosophy would take hold, led by a man who viewed these historic factories not as cathedrals of industry, but as inefficient weights dragging down a stock price that demanded constant vertical ascension. In 1981, the ascension of John Francis Jack Welch, Jr. marked the end of the industrial age and the beginning of the financialization. Welch, soon to be known by the terrifying moniker Neutron Jack, viewed the sprawling GE empire with a surgeon's clinical detachment. His mandate was simple and brutal: fix it, close it, or sell it. If a division was not number 1 or number 2 in its global market, it was excised like a tumor, regardless of its history or the thousands of families it supported. Welch dismantled the very job-for-life culture that had built the company, eliminating over 100,000 jobs in his first 5 years, while simultaneously demanding a level of efficiency that pushed human endurance to its breaking point. He introduced the vitality curve, a ruthless 20-70-10 ranking system, where the bottom 10% of managers were fired every single year, regardless of their performance in absolute terms. This created a culture of pervasive fear and hyper-competition, where the focus shifted from building great products to hitting the precise, penny-perfect earnings targets that Welch promised to the analysts on Wall Street. The General was no longer just building engines, it was building a predictability machine that prioritized the stock ticker over the shop floor. To maintain this illusion of eternal, linear growth, Welch turned to an invisible engine, GE Capital. Originally founded to help consumers finance appliances, under Welch's reign, it mutated into a global shadow bank that eventually accounted for over 50% of the company's total profits. GE Capital was a master of earnings smoothing, a sophisticated accounting maneuver where the company would sell off assets or adjust reserves at the very end of a quarter to ensure they met analyst estimates by exactly 1 cent per share every single time. This financial wizardry allowed GE to borrow money at ultra-low AAA-rated interest rates and lend it out at much higher returns in everything from subprime mortgages to European commercial real estate. By the mid-1990s, General Electric had become a hedge fund with a manufacturing wing attached for public relations. The industrial core, the turbines and the light bulbs, became mere window dressing for a massive, leveraged bet on the global credit markets. The danger was hidden in plain sight, buried deep within the complex 300-page annual reports that few understood, but everyone cheered as the market capitalization soared toward the unthinkable height of $600 billion by the year 2000. The year 2000 was the summer of the General's ultimate arrogance. General Electric was the most valuable company in the history of the world, a $600 billion behemoth that seemed to have conquered the very laws of economics. Welch was hailed as the manager of the century, a corporate deity whose every move was scrutinized and emulated by every CEO in the Fortune 500. GE stock was the cornerstone of every American retirement portfolio, the safe bet that allowed school teachers and auto workers to dream of a comfortable future. But this peak was built on a foundation of precarious leverage and aggressive accounting. GE Capital's balance sheet had grown to over $500 billion, much of it funded by short-term commercial paper, a volatile source of liquidity that could evaporate in an instant if the market caught even the whiff of trouble. The company was also sitting on a massive hidden liability, its long-term care insurance business, which was severely under-reserved for the aging population it promised to protect. The empire was overextended, hollowed out by 2 decades of asset stripping and a refusal to invest in the next generation of industrial technology. The stage was set for a succession that would occur just 4 days before the world changed forever. On September 7, 2001, Jeff Immelt officially took the reins of the General, inheriting a company that was priced for perfection in a world that was about to become profoundly imperfect. 4 days later, the 9/11 attacks sent shockwaves through the global economy, grounding the airline industry that GE's aviation division relied upon and freezing the credit markets that fed GE Capital. Immelt, a charismatic salesman by trade, spent the next decade attempting to pivot the company back to its industrial roots, while simultaneously keeping the GE Capital profit engine on life support. He launched Eco-Magination, a multi-billion-dollar bet on green energy and water technology, but the transition was slow and capital-intensive. Meanwhile, the shadow bank continued to rot from within, holding billions in toxic subprime mortgage debt and Polish mortgages denominated in Swiss francs, exotic financial instruments that were ticking bombs on the balance sheet. Immelt's tenure was characterized by a series of high-priced acquisitions and low-priced divestitures, a buy high, sell low strategy that slowly bled the company of its once legendary cash reserves. The general was no longer leading the world. It was desperately trying to keep up with it. The 2008 financial crisis was the moment the mask finally slipped. As the global credit markets seized up following the collapse of Lehman Brothers, GE found itself staring into the abyss. The commercial paper market, which GE Capital used to fund its daily operations, simply vanished. For the first time in its history, the world's most powerful industrial giant was facing a liquidity crisis that threatened its very survival. The Federal Reserve was forced to step in, providing a massive, backstopped line of credit to prevent General Electric from defaulting on its obligations, a move that would have likely triggered a total systemic collapse of the American economy. The company's prestigious AAA credit rating was stripped away in 2009, an indignity that fundamentally altered its business model by permanently raising its cost of borrowing. To save the ship, Immelt was forced to slash the dividend for the first time since the Great Depression, a move that devastated the hundreds of thousands of retirees who relied on that quarterly check for their survival. The predictability machine was broken, and the trust that had taken a century to build was liquidated in a single panicked weekend of emergency board meetings. The post-crisis years were a slow-motion car crash of strategic blunders and hidden liabilities. Even as the broader stock market recovered, GE remained mired in the ghost of GE Capital. In 2014, Immelt made what many analysts now call the single greatest error in corporate history: the $13.5 billion acquisition of Alstom's power business. It was a massive bet on fossil fuel turbines at the exact moment the world was shifting toward renewables. GE overpaid for a declining asset, taking on Alstom's aging fleet and massive workforce just as global demand for large-scale coal and gas plants began to evaporate. To fund the deal, GE sold off its iconic appliance division to the Chinese firm Haier, effectively trading the company's domestic soul for a graveyard of European industrial steel. Within years, the Alstom deal would lead to a staggering $22 billion write-down, a financial crater so large it swallowed the company's remaining credibility. The acquisition wasn't just a mistake, it was a symptom of a management team that was disconnected from the reality of the energy transition, blinded by the ego of being the biggest player in the room. By 2017, the rot had reached the core. The company's cash flow, the lifeblood of any industrial titan, had dried up to dangerous levels. GE was no longer generating enough money from its operations to pay its legendary dividend or fund its massive pension obligations. In a desperate bid to shore up the balance sheet, Immelt's successor, John Flannery, discovered yet another hidden horror: a $15 billion shortfall in the old long-term care insurance business that everyone thought had been dealt with years ago. This discovery triggered a massive SEC investigation into GE's accounting practices, further eroding what little investor confidence remained. The stock price, which had once touched $60, was now languishing in the teens. a humiliating fall for a company that had defined American prosperity. In November 2017, the board was forced to cut the dividend yet again, this time by 50%, followed shortly by a reduction to a symbolic, insulting 1 penny per share. For the GE lifers, this was the final betrayal, the liquidation of their retirement security to pay for the sins of a management class that had prioritized stock buybacks over solvency. The ultimate symbolic death of the old empire occurred on June 26, 2018. On that day, General Electric was officially removed from the Dow Jones Industrial Average, an index it had helped found in 1896 and had inhabited continuously since 1907. It was replaced by Walgreens Boots Alliance, a pharmacy chain. The removal was more than just a change in a ticker list. It was an admission that GE was no longer representative of the American economy. The general had been demoted to a cautionary tale. The company that had built the electrical grid was now struggling to keep its own lights on. Flannery was ousted after just 14 months, replaced by Larry Culp, the first outsider ever to lead GE. Culp's mandate was no longer to fix the conglomerate, but to perform a controlled demolition. He began a fire sale of assets, selling off the historic railroad division, the biopharma business, and even the iconic light bulb unit, the very heart of Thomas Edison's legacy. The company was being cannibalized to pay down a mountain of debt that had peaked at over $100 billion, a staggering sum that threatened to drag the entire enterprise into bankruptcy. The human cost of this collapse was felt most acutely in the GE towns of the Northeast and Midwest. In places like Erie, Pennsylvania, and Schenectady, New York, the General Electric plant was the heartbeat of the community. When GE cut 12,000 jobs in its power division following the Alstom disaster, it wasn't just a number on a spreadsheet. It was the death of small businesses, the foreclosures of homes, and the hollowing out of the middle class. By 2019, the company's pension deficit had ballooned to a terrifying $31 billion, the largest unfunded liability in the entire S&P 500. To stem the bleeding, Culp took the unprecedented step of freezing the pension benefits for 20,000 American employees, ending the job-for-life promise once and for all. Workers who had given decades to the company, believing their future was secure, were told that their retirement would be smaller than promised, while the executives who had steered the company into the iceberg walked away with multi-million-dollar golden parachutes. It was the final bitter lesson in the new corporate reality. Loyalty is a one-way street, and the worker is always the first asset to be liquidated in a crisis. In November 2021, the final act of the drama was announced: the total dissolution of the conglomerate. General Electric, the monolithic giant that had survived the Great Depression and 2 world wars, would be broken into 3 separate independent companies: GE Healthcare, GE Vernova Power, and GE Aerospace. The cursive monogram, once the symbol of a unified industrial empire, would now be split among 3 entities that had nothing to do with each other. The era of the everything company was over. By April 2024, the split was complete. GE Aerospace, the only truly healthy limb of the former giant, retained the core GE ticker symbol, while the others were spun off into the uncertain waters of a competitive global market. The breakup was hailed by Wall Street as a value-unlocking move, but for the 600,000 retirees and former employees, it felt like the final erasure of their history. The company that had once brought good things to life had been reduced to a set of specialized parts, its heritage sold off to pay for the decades of financial engineering that had hollowed out its industrial soul. As we look back at the autopsy of General Electric, the cause of death is clear. It was a failure of vision disguised as a triumph of efficiency. The company died because it forgot what it was built to do, which was to engineer the future, and instead became obsessed with the mathematical perfection of the present. It sacrificed the research and development that had won it 20,000 patents in favor of stock buybacks that served only the C-suite and the short-term trader. The general story is the story of the 21st century American corporation, a move from the factory floor to the trading floor, from the long-term investment to the quarterly earnings call. Today, the rusted factories of the Rust Belt stand as monuments to a lost age of industrial certainty, while the new GE entities strive to survive in a world that has moved on from the conglomerate model. The light bulb may still glow in our homes, but the company that gave it to us is gone, replaced by a ghost of its former self. A reminder that in the cold world of finance, even the most powerful icons can be extinguished if they lose sight of the people who built them. The legacy of GE is now a fragmented one, a cautionary tale of how quickly a century of dominance can be dismantled by the ego of a few men in a boardroom. The Neutron Jack philosophy, once the gold standard of management, is now viewed with a mixture of awe and horror, a system that maximized profits but destroyed the very social fabric that allowed the company to thrive. The $193 billion in investor value lost between 2016 and 2018 remains one of the largest destructions of wealth in history, a fiscal black hole that sucked in the savings of millions of ordinary Americans. As the three new companies forge their own paths, they carry with them the weight of this history, a burden of debt and broken promises that will take generations to fully resolve. The cursive GE remains, but it no longer carries the weight of an empire. It is now just a brand name, a marketing tool used to sell engines and turbines in a world that no longer believes in the job for life. To the workers in Schenectady who still remember the hum of the factory at full capacity, the fall of GE is more than a financial story. It is a personal tragedy. It is the story of a father who worked 40 years for a pension that was frozen, and a son who was told there was no place for him in the company his grandfather helped build. It is the story of an American icon that lost its way, trading its engineering soul for a seat at the table of the global financial elite, only to find that table was made of glass. The general has left the building, and in its wake it has left a nation questioning the very nature of corporate loyalty and the true cost of progress. As the final turbines are assembled and the last patents are filed, we are left with the silence of the factories and the flickering of a light that is slowly, inevitably, fading into the history books. The technical details of the GE autopsy are a masterclass in corporate failure. From the razor and blade model of selling turbines cheap and making money on long-term service contracts, a model that failed when the energy market shifted, to the aggressive use of Level 3 assets to hide losses in GE Capital, the company utilized every trick in the book to maintain its stock price. But as any engineer will tell you, you cannot ignore the laws of physics forever. A company cannot be 50% bank and 50% factory without eventually facing a conflict of interest that destroys both. The Alstom acquisition was the final pressure point that broke the system, exposing the lack of cash and the overwhelming weight of the debt. It was a failure of the precision engineering of finance, a reminder that the most complex spreadsheet is no match for a simple lack of cash. In the end, General Electric became a victim of its own success. It became too big to manage, too complex to understand, and too arrogant to change until it was far too late. The breakup of 2024 was not a victory for management. It was a desperate act of survival, a way to save the healthy parts of the body by amputating the gangrenous limbs. As we close the file on this legacy brand, we must ask ourselves, what other titans of industry are currently hollowing themselves out in the pursuit of quarterly gains? What other pensions are being gambled in the shadow banks of the modern world? The general may be gone, but the philosophy that killed it is still very much alive in the boardrooms of today. The light bulb, Edison's greatest gift, now serves as a metaphor for the company itself. It shone brightly for a century, illuminating the path of American industrial might. But eventually, the filament burned out. The heat generated by the financial friction became too much for the glass to contain. What remains is a vacuum, a hollow space where an empire once stood. We are left to sift through the wreckage, looking for lessons in the brushed steel and the broken promises. The general is dead. Long live the aerospace division. General Electric's story ends not with a bang, but with a series of filings in a Delaware court and a change in a ticker symbol. The titan that built the 20th century was quietly dismantled in the 21st, a victim of the very market it once dominated. As the last of the GE lifers enter their retirement years, they do so with a sense of loss that no stock split can ever repair. They are the true legacy of the brand, the human cost of a corporate autopsy that lasted 20 years and left nothing but fragments behind. The investigation is concluded. The autopsy is complete. General Electric, 1892 to 2024. A legacy of light, a history of shadows, and a warning to every empire that thinks it is too big to fall. The general has left the field, and the darkness is closing in.